Live.
Hello, everybody. Happy Saturday, and welcome to this new edition of a Self-Directed IRA Saturday. My name's Andrea Chassin. I'm an IRA specialist at Quest, and I'm excited for today's presentation. We have Charles Tassel, who's going to be speaking on the collision of economics and political realties and its impact on investing. So really excited about the topic. Can't wait to go through it. Before we get started, though, we want to go through some housekeeping. So first of all, let's talk about Quest. Who's Quest? For those of you who are joining us for the first time today, thank you for joining us. Quest is one of the largest self-directed IRA custodians in Texas and in the US, I would say. We have about 20,000 active investor clients across the country, so not just in Texas. We have about 2.7 billion in assets under administration. About 108 employees, with about a third of us being certified IRA service professionals. So highly educated staff, always willing to pick up the phone and help you and direct you. We have about 400 million in undirected cash. So for those of you who are looking to raise capital, get to us and ask us how we can help you connect with our clients. Now, before we actually say anything else, we do want to go through our disclaimer. These webinars are strictly educational. Quest Trust Company and these webinars do not provide any tax, legal, or investment advice. So if you need that type of support, please seek for the advice of a professional. So really important there. So let's talk a little bit about what's a self-directed IRA. Self-directed IRA is like any other IRA. Really, the term self-directed is a bit of a made-up term and a marketing term, but really what we use it for is to differentiate the type of investing that you'll be doing, as opposed to your typical publicly traded assets like stocks, bonds, ETFs, mutual funds. Over here at Quest, or a custodian that allows you to invest your retirement accounts and grow them, investing them in the private sector. So basically everything and anything that is not traded in the stock market. We'll go over what are some of those options, what do they look like. So what are the benefits of investing in a self-directed IRA? With Quest, first of all, diversification, true diversification, right? You don't want to have all your eggs in the basket of the publicly traded market, because we all know that like every market goes up and down. So really, when you bring it over to a private, you're really diversifying there. Of course, tax savings. We all know that you can save. That's tax-free way is by investing with your IRA. And then you know best and socially investing. So really, for those of you who are investors and already do this personally and know how to invest your funds, you can do the same within an IRA, basically. So really important there. These are some of the investment choices we typically not limited to these though. Really, there's basically, like I said, everything and anything that is not traded in this stock market. But here's some of the examples. In real estate, for example, we have family foreclosures, commercial properties, condominiums, have tax liens, we have rental properties, basically wholesaling. We also under the private entities realm, we have LLCs, LPs, joint ventures, all those private secured, unsecured, convertible. Every Tuesday and Saturday, learns and also online. So just stay tuned. Whenever you feel like you need more education, we're always here for that. We also have a national networking happy hour. This is for people who are looking to deal pitch. You can come and join us there. It's every third Wednesday of every month. So that's a good opportunity there also to network with people around the country. And then if you miss any of our classes, you can always go to our YouTube channel and our Facebook page because we all post them there. So yeah, we also have self-directed IRA socials. We have every first, second, and third Tuesday of every month in person, but we also stream them for anyone who wants to join us. We have a speaker and an educational topic, and then there's also some deal pitching there if you're there in person. So check those out, definitely. We always have the referral program ongoing. So if you know anybody who is at Quest, or if you want to refer anybody, we do credit both people $25, and you can do this as many times as you want, as you can. So take advantage of that if you can. Lastly, if you have any questions, if you need to consult with us, have a consultation, give us a call, email us or scan this QR code and book a consultation with one of our IRA specialists. There's about a group of about 5 of us who are ready for your questions and excited to help you guys through your self-directed IRA journeys. So go ahead and contact us. But without further ado, let's bring up Charles so that we can start our presentation. Hi, Charles.
Hello. Thank you, Andrea, for having me. Appreciate it.
Take it away.
All right. Well, thank you. Welcome. Thank you, Quest, for allowing me to speak. I appreciate the opportunity from National Real Estate Investor Association, 40,000 members plus across the country. Find us on nationalria.org. I do always want to give a disclaimer. While I often play an attorney on Wall Street Journal, Bloomberg, Fox, all that and stuff, I am not an attorney, so do not take this as legal advice and do your own financial research. Having said that, let's look at some interesting things here and kind of see where this collision of politics and economics is taking us, and hopefully not stabilize your stomach. Just it's a little bumpy ride, but we'll get through it. And I want to show you some of the silver that's in the lining around some of these storm clouds we're viewing. So with that, some people are familiar with SETI. You're looking for legislative good news. Well, okay, let's deal with reality first. Whether it's the dumpster fire that is turning into this economy or what, from banks to gas prices, again, back up again. Anybody got any little golden nuggets called eggs? Those are little pricey at times and sometimes hard to find. But let's jump into the what and wherefore. And part of that is the interest rates and inflation, and that those two there and what they're causing, what they're doing. So I saw this before. It was stocks and cryptocurrency. I added banks in there just to kind of that little reminder that, one of the longer term issues when Jerome Powell back in early summer of 20 says, no, the interest rates aren't going anywhere. We're not raising those at all. And banks locked in. And that's been part of the problem. This is kind of what we're expecting, is this specter of death approaching the real estate market. And people in the real estate market are like, is this 2008 all over again? And I want to assure you it is not. And I'm going to go through a couple of reasons why it is not. But there are a couple of facets of the real estate market that are concerning. And there may be some opportunities. So don't just go, oh no, it's a problem. There are opportunities there. So with that, let's look at some of those. Now, background wise, and I started these off with kind of red letters and green letters to give you the good versus the bad. So yeah, there's a lot more red than there is green. But let's consider that starting off, central banks are still raising rates. The ECB just raised a half point, last week. There is continued war. And the problem is with the war, there's a destabilization from the food prices and issues going up to oil to supply parts. And what that does from shifting other parts of the world, there are ongoing destabilizations. And the concern is are we going to see war and or civil war in more areas? And the likelihood is probably civil wars, whether that's in central parts of Africa, or if we start looking down to southern America, Central Africa or Southern America, those two areas, South America might be in trouble with a couple of different countries that are very unstable and the politics are heating up tremendously. That could lead to more destabilization. So again, that war, destabilization, we could see an increase on that. And that will have some impacts, again, more ramification, more dominoes falling. Think of those as waves going out in the water. Now, having said that, I want to focus in on America here, on specifically on the real estate. And if you look at it from the rental market specifically, I want to go to this post-COVID psyche we're referring to. People, when they got locked down, said, you know what? I can't do this. I can't be locked in this small space. Or they've got a roommate and they said, there's two of us in this 2-bedroom. Somebody's got to go. And at some point, somebody did go. And what we saw both in multifamily rents and in single family rents is the occupancy rates stayed very high, even though people were moving out. Because what happened was inevitably, one person in a 2-bedroom moves out. The other person says, no, I'm staying. I'll take the 2-bedroom. I'll use the other room as my office. And even though we're only seeing, it's been slowly dropping from about 26% down to 17, 18% rate of home offices, people that have the opportunity to do that are doing it. Now, they're also shifting some of their locations a little more, and we've seen more of that. We've seen more of a city core out to suburb, and even tertiary and secondary markets are seeing an increase in population. But that post-COVID psyche that says, I need a little more space. If things go down this road again, I need to make sure I'm covered. And that's one of the things that we're seeing that's really helped out with kind of the occupancy and maintaining occupancy in rental markets. So that work from home, we'll touch on that a little bit more, but the problem is, of course, that also means there's another domino falling, which is commercial vacancy. Now, one of the good sides to this is not like everybody moved out and now there's too much space. It's as these leases are coming up and these commercial leases are coming up, the vacancy rates are starting to climb. Some of those vacancies have been on the books for 1 year, 2 year, 2.5 years. But some of them, those leases don't always all come up at the same time. So because they're longer term leases on the commercial side, that has helped slow and stabilize the market a little bit, providing some longer duration in there. But that is coming due. And whether it's the vacancy rates or some of these leases that are coming up from properties that were purchased during very low inflation rates, and when your inflation or when your interest rate surpasses your cap rate, you got a problem, especially if you bought it on something where it's an interest only payment on a lease or on a mortgage. That's going to lead to problems. We're seeing construction climbing. The last time multifamily housing was in this type of construction phase was in the 80s and early 80s at that. And we'll talk about some drops recently, but I want to mention to you that overall, there's been about 10 years of underbuild in the multifamily area. So that is catching up. Now, single family has been kind of that fluctuation capacity. So as multifamily has been under capacity, single family has been benefiting from that because people who want some space, who typically would come into the single family rental market, are now really heavily in demand. And we've seen a lot of the build for rent, and we're going to continue to see build for rent. And that's one of those issues that we're going to come to, and we'll refer to this later as big housing and corporate housing coming in, and we'll talk about that. The concern, though, is are we going to reach an overbuild? And I'll show you some graphs here on millennials and where we're coming in, and literally the newest group after the millennials, and we keep going down the alpha group that's coming in. That's the new alpha generation that's coming in. I think they're still working through the naming of this, but we'll get there. But the question is interestingly, around the world, everybody's had the boomers. Everybody had, the kind of bump after that. Millennials in the U.S. are an actual bump in demographics that a lot of countries did not have. Our country was doing well, and people had extra kids. They had we'll have 3 kids rather than 2 kids, or we'll have 2 kids rather than just 1. And because of that, what we're actually seeing is a bump in our millennial demographics that other parts of the world are not seeing. Therefore, the beauty of this is that we're actually not going to have the same fall off and then therefore deflationary aspect that you'll see in other areas, in other parts of the world. So let me show you this. Put my glasses on here and make sure I see it as well. The found generation back in 2015, they looked at the numbers and said, here's where everybody's at demographically. As you look beyond Gen Z coming, there's, again, alpha generation. We're all the way through the alphabet back to A again. But as this millennial group is coming through, they are fully into their home buying mode. They're family building, again, about 3 to 4 years later than previous generations. But with the boomers saying, you know what, COVID, I've had it, I'm out. Okay, so a lot of them left even faster than was expected. Now there's millennials, and millennials are doing things their own way. Again, refer back to the office option. And people saying, I'm doing a home office. I don't want to come into an office. Interesting impact on networking, but we don't have time for that. But the issue of millennials and where they're going has been really kind of the focus. And the good side for the US is we have a millennial bump. You can see it there in the chart on the right that other parts of the world do not have. That's going to stabilize a couple of things. It stabilizes and extends our housing for a few more years. But if you look behind it, Gen Z is not coming up nearly as quickly. And that's where is there an overbuild in that will start to impact us in, say, 25, 29, 30, somewhere around that range. And so that's one thing that we're considering. Just keep in mind as you're doing your investments, maybe being ready to be liquid in those kind of times and watching what your investments are. This here, and just, the Fed always, they say the Fed raises rates until they break something. Well, a couple of banks have broke, and if they start forcing a mark to market, there's a lot more banks that are going to go. Now, the concerning part is we have lost a lot of small community banks, and those community banks have typically done a lot of the funding support at the local community level. And that's problematic because with what we're seeing at a federal level, money is actually coming out of a lot of those banks, anything over $250,000 for FDIC insurance, and going into the big banks, and then therefore making them even bigger when they're supposed to be too big to fail. Now they're getting even bigger and bigger. So there's a little bit of a problem with that the Fed is trying to figure out how to work out, and whether it's a takeover of just outright, or they just leave them there and claim that they're separate. We'll see what happens with that. So housing affordability. And I want to show you both of these. Take a look at this. Left chart is from Freddie Mac and talking about house prices. So yes, we saw house prices jump up. They are leveling off, and we've seen the level off in a couple of areas, whether it's a Phoenix, a Colorado, kind of the Denvers, the Boulder Springs areas. A lot of these high risers, high flyers have dropped off 15, 20%, cooled off. But what we've seen is even the tertiary markets, the sub-markets, those secondary areas from rural areas all the way out, those areas are actually, what we're seeing is they've had steady raising rates as well. Maybe not the 20, 30, 40% bumps, but they've seen some good 7, 10% consistent bumps. And that's been very beneficial for real estate investors across the board. The downside to it, though, is if you look over to that chart on the right, that chart is a little more concerning, because now what does your money actually buy? And I was kind of interested, the 400 million of undirected cash, it's like, if that's not getting invested, you're losing value. So I encourage you to get that money invested, find a deal, get into an asset, because inflation helps as the assets grow, and you want to make sure those funds are invested. So otherwise, we're closing in, and if those two numbers start to, those two lines invert much more, you're losing money, losing the value of your money. And we have an expansionist monetary policy at this point. And part of that is we're bumping up with, as we referred back to the banks, you cannot continue raising interest rates without forcing more banks to fail. And yet with war and destabilization, there's going to be increased inflationary impacts. So rock, hard spot, that's where the Fed is at right now. And so there will be some interesting impacts coming forward. But the nice part is when it comes to the housing side of things, not necessarily commercial, not necessarily other parts of the real estate environment, especially single family homes and multifamily, there's going to be a stabilizing side because of that millennial bump. Now, I do want to mention this. This is where we talk about inflation versus deflation and the impacts. Most people buy a house just like they're buying that car, $169 a month. What's my payment? What's my cost? And when we look at what the numbers really are, if you're buying a $2,000 payment, and that's what you're thinking in terms of, at 3% interest, you're buying a $600,000 home. Okay, great, fantastic. But when the interest rate goes up to 6%, now you're looking at same $2,000 payments of $420,000 house. You start putting more limitations on it, and with the credit tightening that we're seeing, you're buying smaller and smaller houses. And let's face it, at 7.5%, you might be looking at a $380,000 house. That's a different house typically than if you're looking at a $600,000 house. So what's the value there? And for millennials, they're still seeing a value proposition. But I want to point out, and this goes back to an article that came out in The Economist in 2012, and that is there was analysis done that the most stable appreciating asset in the entire world is a single family homes in the United States. And that is where institutional money started pouring in, and more REITs and other groups really started to grow about 2012. And they started to go, this is where we really want to put our money at. We've seen Turkish money fly in, and we've seen Chinese money coming in. With destabilization in South America, we've seen more South and Central American money coming in. And they're fleeing those markets to come into the U.S. to buy into this market. Now, what that does is forces some of the institutional buyers, they have to buy. And they may buy at 10% over, 20% over. But that's the price of doing business. So they've got to get that money out there, and they've got to get it spent. So having said that, it's a very small part of the overall impact on housing, but it's getting a lot of play. And whether it's February in the Senate with hearings on it, or ongoing discussions in the House, that institutional buyer is really going to be a focus. And we'll talk about that some more here in a minute. But I do want to mention on the DC side of things, a couple of things that are focused, that even though there's all this inflationary impact on housing and possibly some deflationary impact on multifamily housing as the interest rates surpass the cap rates, some of those properties are not going to cash flow anymore, and they're going to have to probably sell. They're going to be moving out, but there are plenty of buyers for them right now. There's plenty of money out there. So it's not like it's 2008 and 9 where it's, trying to sell something and there's nobody there to buy it. There are still people there ready to buy it, but they got to make sure that the deal actually looks good. And that same mentality, HUD and FHA are still saying, we want to make sure that first-time low-income home buyers are getting support. So FHA is working on putting some more programming together, putting some more funds together. And the White House has instructed FHA to put together a funding program for chattel loan. You say, well, what's that? That's if you've got a mobile home. So a modular home, a manufactured home, a lot of those don't have the ability to do an actual mortgage. They have to do what's called a chattel loan, or often called a personal loan. Well, if FHA comes behind the scenes and backs those, a lot of those smaller loans that may be $10 to $30 to $50 to $75,000 will then get supported, and that will give a lot of low-income buyers the opportunity to get that first rung of the ladder. So there's some opportunity there with chattel loans. But again, FHA has been working on that for a little while. They have not rolled out what the regulations are on it, but they are working on that. So we will hopefully hear something on that side of it soon. I mentioned the multifamily side. Apartment buildings. This is Wall Street Journal. This is an article by Will Parker just last week. Will's a little bit on the left on how he's presenting things typically, so just bear that in mind if you do look up this article. But if you look to the right, you'll see some of the production side of things and the dollar amounts involved with it. And what I want to point out is, even if there's a drop off like this, a multifamily property, whether it's a 60 unit or a 600 unit building or a 6,000 unit complex, is not built in a year. This is a 3 to 5 year process. So when you start thinking in terms of multifamily, okay, there's a big drop. Well, okay, that's nice. So some of it was finished up last year, and now in the first quarter, there's not a big movement. No big deal. This is a pipeline issue. And what we've got to do is kind of back out of this micro and the headlines and really look at what the pipeline is. And the pipeline is we are moving forward with more multifamily than we have in the past probably 8 to 10 years. Now, there's a lot of nervousness, and people have the ability to say, okay, we're going to build phase 2 and 3, but we're not building phase 4 unless we're leased up. And that is smart. That is not a bad way to do it. But there is that pipeline that's coming, and a lot of properties are sitting there watching this. The challenge they have, and we'll touch on this in a minute with some different states, is rent control and that issue there and what it means. So we'll come to that here momentarily. These are some couple of pictures that were prominent during COVID. And I want to mention, I'm not trying to be partisan or anything. This isn't Democrat, it's not Republican. This is an issue that's going on that we are having a dialogue in one sense that is, are we going to have individual property rights? Are we going to have the ability to actually rent housing, sell housing? Or is this something that, well, housing is a right and therefore people should have access to housing no matter what? That's part of what the battle is behind the scenes. It was amazing how fast some of these pre-printed signs rolled out in different areas, which tells you there's some money behind it and some efforts behind the ideology. But I want to give you a heads up. Look beyond just the partisan aspect of it to what's going on behind the scenes of who's pushing what. And that's really what's part of going on with these issues. So with that, let's look at this aspect. And this is part of what the creating the narrative is. It's the David and Goliath idea of, these big guys are out there. Everybody's been familiar with the pejorative statements about big oil or big pharma raising the rates on everybody's prescriptions. Okay, well, big housing is now coming in. Again, since 2012, funding has been coming in, but the majority of housing in America is owned single family, small rentals by individual owners. Literally big housing, quote unquote, is approximately 1% of where we're actually at in the housing side of things. So it's not huge numbers, but that's really going to draw people's attention. And that's part of a narrative that's going after. There was an issue in about 2 years ago in Berlin, Germany, where they basically nationalized anything that was 1,600 units or more by a single owner. So not 1,600 units, 1,600 units owned by one person that they went after. And it was like, it's just, that's part of the nationalization effort that's going on, again, globally and starting to take root in the US. And we'll talk about some of that and some of the legislation that's coming forward and actually regulations. Part of what you're going to hear, though, is this. These are some of the myths that are out there from a progressive side of things saying, okay, people are spending more than 50% of their monthly budget on housing. And we have pushed back on this repeatedly and said, we won't rent to people if they don't have, the standard, usually 28 to 30%, maybe 33. If you don't have at least 3 times the income, not renting to you in the first place because you're not going to be able to make your payments. So it's one of those things where this issue's out there that people are doing this, people are spending this, and it's like, okay, you might find one person who lost a job or, but that's not what's really going on, but that's the narrative that's being pushed. So be ready for that one, to hear that one. Again, the book that's out there, don't buy it, look at it. If you need to read it, call Evicted. Talks about how evictions are so profitable. Evictions are the worst part of any of this business entirely. If you're doing any kinds of rental property, it's the soul killing part of the business. We hate doing it. And it actually costs a ton of money. It is not profitable. But again, that's a narrative for people who've never been involved. And they push that. And then by pushing that, it makes it, oh, well, you're evicting people, therefore you must be making money. And therefore we're going to put these regulations on you. Again, investors are buying up all housing. This is an issue that's been brought up from perspective of whether it's cash purchases or the corporates and saying, well, wait a second, why are you guys doing all that? Why are you buying up all this housing? The reality is there's been very limited amount of housing supply on the market, and the amount of housing that was being purchased by real estate investors, it actually dropped in overall numbers, but the percentage went up. So again, headlines. So make sure you're looking past the headlines to figure out what's really going on in that story. The other piece is landlords screening out good people. Good people can't find a place. We need to address screening limits. And this is really an attack on the risk factor in your business. Do you want to rent to somebody who's going to drive their motorcycle into the middle of the building, tear it apart, pour the oil down the drain, and get mad at you and pour concrete down the drain and then leave? That's the kind of thing we're trying to say, that's not who we want to rent to. We really want to make sure we'll be able to do, if I can't do a background check on somebody, how do I know that even if to turn it around, the single mom that I've got living on one side of this duplex, how do I know I'm not putting in somebody who's really problematic? And I'm not even talking about, somebody who's a child abuser or anything like that, but even just somebody who's violent or threatening or selling drugs, using drugs, bringing in that kind of crowd. How do I know? I want to make sure I'm taking care of not only my property, but the residents as well. And so this is really an attack on the risk factor on our businesses. And this is something that's got to be pushed back on. And we're seeing this being pushed at the local municipal level. And it's really something to bring in a local resident who says, I want the property owner to be able to do screening, because if they can't do screening, who knows who's going to move in next to me? We need that. So this is one of those things from a myth perspective, we need to make sure we're out there addressing. So I'm years of being a lobbyist, working on, don't hate me for that, years of being a lobbyist, working for property rights and housing rights is, if you're not at the table, you're on the table. And I love the Chick-fil-A piece here. It's the cow saying, go eat the chicken. Don't eat us, go get the chicken. And I think that's very apropos in politics, because if you're not at the table, they're like, oh, get those property owners, get them. They're the problem. And that's the terrible landlord, right? Well, when was the last time you were lord of the land? I like to be lord of the house when my wife's not around, but that's about it. So there's no serfs, we're housing providers. And if we are not aggressively engaging, and I mean that in the sense of really getting out, talking to people, making sure they know who we are and what the investments we have in a community. This turkey got it, he got released. Every other turkey that Thanksgiving didn't. And that's part of what we're looking at with the nationalization of housing. So let me move on here a little bit. And you don't need to read the fine print on the right. I'm using this as an example. And I focus on this because sometimes people say, I don't know what I'm supposed to say if I go talk to, we've got these issues and we're going to go into some detail on what they are. But how do I deal with these issues? Well, this is actually a summary from ChatGPT. And I think Carl Jung's point is exactly right. You've got to learn to ask the right question. Otherwise, you don't get the right answer. And chat can actually help you and put together statements. And, most people don't like public speaking, but folks, we're typically salespeople in some sense. We're, whether it's, selling the lease, selling the property, doing something, we do sales of all kinds, but we don't know this issue. Well, this is an area where using one of these chats, going in, asking the questions, and then personalizing it can really give you a leg up to bring some truth to the matter. So I just give you that as a thought for some feedback to how we can always do more and do better. So let's dig into some of those issues that we're dealing with because of the myths that are out there, because of all of this, the logjam that's out there politically, but also the economic crises that are going on both at the macro level around the world, and then not just globally, but in the U.S. itself and the impact here. Bluntly put, we've got a legislative logjam. We all know that. That means there's Republicans in charge of one house, Democrats in charge of the other, and things get done like this, which is how it was designed to be. So that's a good thing. It's a check and a balance. Actually, was just up in DC last week. Flood insurance, they are moving that forward. They're going to reauthorize it, which will be good. The difficulty is what they really need to do is actually put about couple $1 billion into it and actually reconstruct it. They've done some reworking of maps on it, but I can tell you, and I shared with them, I'm happy to send up a couple examples of, if I buy federal flood insurance, it was $27,000 a year. If I bought market flood insurance, it was $1,200 a year. And it was an apples to apples comparison. Which program do I want to participate in at that point? So they need to figure out how to redo the flood authorization, because there are some areas where you can't get the market, and the Fed does need to step in. So they need to rework that program. It is going to be reauthorized. They are still working on the revision of it. So we are working on, in partnership with the Seller Finance Coalition, a new version of HR 5013 should be coming in. This is a ability for increasing the access to affordable housing for that lowest rung of the ladder. And really what it does is it opens up part of Dodd-Frank with a laser focus. And instead of allowing somebody to sell 3 of their own pieces of property in a rolling 12-month period, again, 3 of your own pieces of property, that's it, no more. This would actually open it up to 24 in a rolling 12-month period, which for the most part will take care of a lot of folks who really have built up a portfolio over the years and now want to seller finance them or installment loan them, sell them themselves. And a lot of these folks are unbanked. So this is a good way to get those folks, give them an opportunity to get that first traction, that, get their first asset and start building real estate wealth. Part of it is we are watching the eviction tracking bill, seeing where that's going to go. These other ones, YIMBY, which means, of course, everybody's familiar with NIMBY, which is not in my backyard. This is yes in my backyard. And whether it's YIMBY or some of the choice issues dealing with Section 8 reform, a lot of times what happens is these bills are floated in Congress, and they may start off as a 200-page bill that covers 20 different regulations. Well, by the time it moves forward 4 to 6 to 8 years later, it's actually a much smaller bill because a number of those regulation changes have been taken in and incorporated. In fact, some of the development limitations and development incentives have already been forwarded by HUD and said, yeah, we should do that. And they're doing it before Congress even votes on it because they're just regulatory changes that they can actually impact. Privacy is an issue, whether it's TikTok or some of that, you're seeing that in the headlines, but that privacy conversation is going on right now, and we're not sure where that's going at this point, but I just want to give you a heads up. Make sure you're listening to that issue and making sure you're paying attention to your attorneys. If they're talking to you about if you're doing any kind of debt follow-up, making sure you're doing it correctly. Right now, CFPB is looking at some different options. We know that there's a variety of efforts and conversations going both in the House and the Senate, and we expect to see some more bills coming out on that soon. So one of the things that happens, folks, is when the House is doing this and the Senate's doing this, the White House can't get things done, and whoever's in the White House says, well, I have one other tool, and that's the regulation side. So they are going through all of those letters, that alphabet soup, and pushing out regulations. So we are tracking a variety of those pieces of legislation on our website. And I just encourage you, there are different organizations like ours across the spectrum representing different facets of our industries. They're going to be reaching out to you saying, hey, we've got to reach out to EPA on this issue, or OSHA, they're changing some rule, or CFPB wants to change this rule. We need to reach out and get the conversation going. All you have to do is fill out some basic paperwork and send it in, or an email. Please do that. The more voices we have weighing into this, the better impact we can actually have. So, and it's critical to do that. So I'll just reiterate that piece of it. This is a little bit of an ugly slide, and I apologize for that, but I wanted to share with you, this is the Renter's Bill of Rights. And I use the Alice in Wonderland background on it because this is one of those, how far down the rabbit hole are we going? As I mentioned, if you can't get things done legislatively because of partisan divide and partisan head-to-head butting, you start running into, okay, we're gonna put regulations out there. Well, what happens if you can't even put the regulations out there because they're way beyond your scope? Like, say the 10th Amendment might actually block it. Well, then you do what they did with the Renter's Bill of Rights, which is they put it out there and say, please do this. Anybody who can, please, here's some ideas, take these ideas and do them. even though we know that we can't really do them, this is what we'd like to see. And this is that ideology that's very, very dangerous in some levels. And I'll go through these. The first one is protections against evictions. Folks, eviction and housing providing and landlording and all of that together is a state issue. It's been a state issue, and it should continue to be a state issue. So for the feds to say, oh, like on page 17 of their document, paragraph 3 goes into this aspect of, well, the states aren't doing this and they're doing it corruptly if they are doing it. It's like, oh, so every bar, every judge, every magistrate that handles evictions has been doing this corruptly until you guys showed up? Wow, I bet those judges would like to hear that. I mean, that's the level of statements they've made in this document. They believe that they need to put more protections in there against evictions. And our suggestion to them was, well, the best protection against eviction is making sure that you're renting to the right person in the first place. So allow us to do good background checks. Of course, that's gone nowhere. They, again, put this out there hard. Rent control as far as affordable housing. As costs go up, this issue of rent control continues to be, everybody remembers the guy who ran from New York. The rent's too darn high, and he'd go out there. There's a group of people that are still continuing to use that mantra and push. And there are literally back and forth between the states. We've got about almost an even split. There's about 32 states that have rent control preemptions, but you've got another 20 states that are going, okay, we're going to look at it. And yes, there's an overlap there. I'm not miscounting the states. There are a couple of states that have preemptions that are looking at rolling back their preemptions. Illinois is an example of that. So be very aware of those rent control and know where you're investing, because that rent control can have a huge impact. Minneapolis, St. Paul is one of those areas where there was literally thousands of units going to be built, 2,400 units. They stopped at 400 because they said it doesn't make sense to build these other 2,000 units, because with rent control, it makes no sense. We're just going to continue losing money, so we're just going to stop now. $40 million into an investment, build 400 units. That's it. Yeah, ugly numbers on that. Health and safety standards. Yeah, did you know until the feds came out and raised this issue on the Renter's Bill of Rights, there were no health and safety standards out there? Isn't that amazing? It's just like, this is the frustrating part of this kind of documentation. When they send this out, we want equitable safety standards. We want equitable health and safety standards. And it's like, that's a city standard. That's a municipal standard. That's a state standard. And they've been doing that. That's why we have building inspectors. That's why we have health inspectors. That's what their jobs are. You might want to let them know that the White House doesn't think they're actually doing their own job. So that's part of what we're looking at with health and safety standards. And then the other side is fair and equal access to housing. And this is one of those issues that HUD is actually doing some incentivizing, because there are some things, again, it's an interesting conundrum in that areas like, say, California, where it takes 3 to 5 years to go from buying the land to get your zone changes and all that. So all those carrying costs for new development take longer. Well, they realized, you know what? You have less housing options there. Well, when it increases the cost of housing, that increases it has a disparate impact. In fact, they've actually just come out and ruled that disparate impact is now back in place as it was during the Obama administration. And that side of things is going to be very difficult to deal with, because it's going to be, we think we should be doing this kind of a policy, and this is how we're helping the community. Somebody else, all they got to do is argue with it, and it goes to court, and it's federal court, and we'll deal with it in a year or two, by the way, with lots of expensive attorney fees. So lots of problems with this issue. Again, the Renter's Bill of Rights is a non-regulatory statement about how everybody else can do regulations. And then, by the way, these regulations, we're not even doing them in the White House and the administration right now. That's how hypocritical it is. And you can reference that if you go to our real estate investing today, little lower right corner there. We have a statement in there about the background on the Renter's Bill of Rights and what should be done with it. So I'll share that with you, and we'll drop down to the state level a little bit here. I mentioned, rent control, 26 states. They're looking, I think I said 22, but 26 states are looking at rent control or various versions of it. A variety of other things out there. Source of income. By the way, source of income, people kind of hear SOI and they move past that. That means is the government becomes your partner no matter what. You use their lease, you accept their contracts, you accept their program no matter what. That is a very problematic situation because you're basically giving up a lot of your own property rights. So source of income is very detrimental. If Section 8 were actually in a good program and people would want to participate in it, it's not a good program and it needs to be fixed. And instead of fixing it, they want to just force it down your throats. So that's what source of income does. Eviction controls, there are a lot of things like the bans, extending the process, even the 30-day extension for if it's a federal property, right to counsel. So this is an idea that, well, these landlords come in and they have lawyers that back them up and our guys lose. Well, the reality is if you've got some background and you've got an LLC, you typically have to have an attorney because you can't represent yourself. So you have to have counsel there. And that's an additional cost and it increases the cost of housing, but it's part of what you do. And guess what? If they haven't paid the bill, yeah, they're going to get evicted. That's pretty straightforward. Right to counsel says, well, we need to have a jury trial about that. And we're going to make sure every one of those poor residents has a attorney representing them rather than actually helping them pay their bills, which would actually help them in the long run. But that's some of the stuff we're seeing. Security deposits, I'll just mention there's a couple of things on this. The elimination of criminal background checks is one of the most problematic. And I should mention this too, late fees. In early March, Secretary Fudge, Secretary of HUD, came out and said, in following the White House's instructions on getting rid of junk fees, we encourage everybody to get rid of all kinds of junk fees, like, late fees, application fees. Those are junk fees. Like, a simple response was, okay, when the IRS stops charging late fees, then we'll look at stop charging late fees. Until then, you clean up your own household first. But again, they can't change that regulation internally. They just tell everybody else to do it. So that's part of the difficulties we're dealing with. I'll keep moving here. This is one of those areas where, from an investor perspective, I really encourage you to make sure you know what you're doing in, or which municipality your property is in. It can have a huge impact. And if you are in, a red state and you're in a blue city who's trying to make a point, be careful, because that's where you'll end up just holding your breath, beating your temples in. There's a lot of problems. If I can encourage you anything, the solution, be engaged. Please, please, please be engaged. It's absolutely critical. It wouldn't be appropriate if I didn't talk about the fact that, when we're talking about the internet, everybody's watching and there are a lot of things going on. So I want to mention this, and this is a part that our government is working on some pieces of this, but a lot of this comes through directly to individuals. And I encourage you to make sure you've got your computers backed up. You've got your virus protection on, all of it. You got your computer backed up, if not weekly, monthly, please do so. There's no faster way that somebody will try to scam you out of money. I sit down with a friend of mine who's an attorney who works for a bank, and he talks to people every day about not getting into a scam. So I encourage you, you're in the right track by, working with an organization like Quest, going through good investments, going through something that's vetted. Just be careful if you see something coming through your computer. Do not click on links in any computer, any emails that come through. I just have to say that going through. So here's a couple of things. The other one, make sure you use your own passwords. Don't use password. Don't use the whatever the generic was that came in. That's what the Internet of Things does. And whether it's from Iran, North Korea, or Russia, those are the top three areas that are attacking us on their computers. And it's state-sponsored beyond just China. It's state-sponsored hacking, and they're coming after us for a variety of things. Now, they will come after IRS filings. I will mention that. So make sure you're doing your IRS filing. Make sure you're following up on it. If you get a document that says, oh, you've already filed, make sure you're following up on that. Do not drop that. Something that's out there, we had dealings with HUD on this issue, and it was regarding support animals. I didn't say service animals. I'm saying support animals. These are a pet that somebody go like, oh, I need to have this pet. And they can have their yoga instructor write them a note on a napkin. And guess what? It's fairly legitimate at that point because HUD has said so. And there are so many scam websites out there that when HUD was doing this research, their general counsel had his laptop actually crash because there were so many scam sites that were like, oh, you're tracking emotional support animals. Here's our stuff. That's how bad it is out there. So yeah, there's a lot of problems out there. Be careful. And even listing your EIN number on a housing choice voucher form, have them call you, make sure you're getting it and not handing it back to your residents, who then you can use your EIN number to create a separate company or a loan or anything else. So be careful with that. Like I said, I'm not trying to say this is, everything's horrible. It's all burning down. Now, I do like the Chinese stratagems. I got 3 of them there listed. Fish in troubled waters is one of the ones I like to refer to. That's where we have opportunities. There are going to be opportunities with some of these larger, call them big housing, some of these larger corporate housing that are in over their head. And as the credit standards go up and as the cash starts to tighten at the corporate level, they're going to be in trouble. And they're going to have to start exiting different communities, and they're going to have to start leaving some of those properties. Those are going to be opportunities. There are going to be multifamilies that purchased. And for some, there's going to be questions on, there's going to be opportunities on these multifamily properties that purchased an interest rate or an interest only loan. And now the cap rate or the interest has passed the cap rate. I can't even talk anymore. I'm talking so much. Sorry. Trying to get it done quickly here, but those are going to be opportunities. So please understand there are opportunities out there, and there are going to be more of them coming, but it's going to get rough. And that's really what we want to see for opportunities in some sense. We want to see, okay, time for the shakeout, not a bailout, but a shakeout, and it'll give us an opportunity to buy some of this real estate. So I'll put this up here for questions, and I'm not sure if there's questions that are coming in here. Andrea, I don't know if we have questions. No questions so far. Perfect. Answered everybody's questions, Rob.
Yes, not questions. No questions come through yet, but thank you very much, Charles. That was a very interesting presentation. Definitely a lot of really valuable information. So I want to thank you for coming on here today, and everybody else for joining. I think if no questions come in, then we could just close off and wish everybody has a great weekend.
All righty. Well,
Okay.
Thank you very much for the opportunity, Andrea, and appreciate all that you and Quest do for investors across the country.
Thank you very much. If you guys want to contact Charles, here's his information. Similarly, if you want to talk to us about self-directed IRAs and investing, go ahead and contact us. Thank you.
Thank you.
Have a great weekend.